Hello, everyone, and welcome to this weekly market recap for the week ending March 7th, 2025. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and it's a pleasure to be with you all again this week. Got to tell you, it wasn't a great week, and I really don't like what I'm seeing in the market. Early on, it looked, like a correction was in order. I mean, we just had a lot of issues going into the end of the year. I talked about this back at the beginning of January at our Market Vision 2025 event. That's our annual event where I give my call for the year. And most of the calls have been pretty spot on over the last 6 years. And I think this one's been pretty spot on as well. I talked about a correction. I thought the first quarter would be very challenging. I don't remember the exact number, but I thought that we could get down 10%, maybe 5,500. We haven't quite got down to the 10%, at least not on the S&P. We did actually hit a correction on the NASDAQ 100 on Friday. At its low, we were down over 11% since the all-time high. So we're going through this period that definitely has been very challenging. And I'm seeing some signs that suggest it might become more challenging. I'll talk about that more as we go through the next several weeks. I'll give you a couple of charts today in this video that will maybe help to explain some of what I'm seeing and some of the reasons why I'm starting to grow a little bit more cautious. Throughout the week, I'm just kind of looking at the market action. I'm not really sitting down, taking a look at everything that's happened and with the markets all closed and so forth. And I did that here over the last day or two and starting to see some signs that suggest that this could be deeper than just a correction. And again, I'll talk about that more as the weeks go on. I'll give a little bit more explanation in our weekly market report to our members. So if you're not a member, you can certainly join and become a 30-day trial member and check that out. I think these next 30 days are going to be incredibly telling as far as what's going to happen to us throughout 2025. So it'd be a great time to take out a free trial for sure. And we'll talk about that in a little bit. But right now, I mean, we got a lot of talk about the trade war. Everybody knows about that. We talked, of course, about a lot of the things that were setting up for the market to take a little bit of a drop. We had, bullish sentiment, which really needed to be corrected. We had weekly negative divergences. We've had some rotation, some really, really poor rotation, especially in the consumer space, where over the last month, I'll show you, but I think there's like a 14 percentage point difference in the last month between consumer staples performance and consumer discretionary. And so that is in my view, a very, very key warning sign. It's telling me that folks on Wall Street are getting out of some of the aggressive areas. And now we're starting to see those aggressive areas really begin to tumble. And it's interesting because we finished the week with a little bit of a reversing candle. So I'm kind of feeling like short term, maybe we get a pop this week. If we can't get a pop this week with that kind of reversal on Friday, that would really start to send some more bearish signals. But anyhow, let's take a look at the numbers. Let's get to the numbers. I got a lot of charts I want to show you. Try to get through this in a reasonable amount of time. So let's start off first with the weekly recap here of our major indices. You can see the transports held up best, dropping 2.35% this past week. Then you had the Dow, S&P down 3, NASDAQ down 3.25%, mid caps down 3.5%, Russell 2000 down 4%. And notice again, when I started the year, I really thought that and I said this last year, when rates are coming down, I think it really benefits the small caps. And it has, when the market has been believing that we're going to get rate cuts. But when the market's believing we're not, that's when we've seen everything flip and small caps underperform. And that's where we're at right now. And we're seeing that continue with the small caps. I'm going to flip this from 1 week to 1 month and take a look at what's happened over the last month. Again, transports in the Dow doing the best, down about 3%, a little over 3%. S&P a little over 4%. NASDAQ 100 is 6%. Mid caps almost 7%. Small caps almost 9%. So we still have that same configuration here over the last month or so. It just seems to be accelerating a little bit now. Which again, once the distribution or once the rotation has taken place, that's when we tend to see an acceleration of selling. And that's certainly been the case so far. Let's move on to the sectors. So here is the 1 month. I'll go back. I'll show you what happened last week, but here's the 1 month. And consumer staples, the best performing group over the last month. And if you own some of these consumer staples groups, maybe the food products and some of the uh, trying to think what other areas have done well. Anyway, it doesn't really matter. Consumer staples, just keep in mind, up 4.4% over the last month. And you know what the market's done? Market's been going down. Consumer discretionary, the worst performing group, down almost 9%. So some of the areas that are heavily weighted in consumer discretionary, some of the stocks, you got Amazon. Amazon went back below $200. Remember, it wasn't that long ago. It was up 240. Now it's back down to under 200. So you look at that and you're almost to a bear market in some of the stocks. And certainly you are in a bear market when you look at Tesla. So Amazon, number one stock weighted in the consumer discretionary group. Tesla's the second one. Tesla was up to 400 and I don't remember how high it got, 400 and whatever, 450, maybe even more than that. I don't know. Anyway, it's come back down. It's probably close to half what it was. That's a 50% haircut. So whatever the market is seeing, it's not good. And, we've seen in the past where we've had an inverted yield curve and it's come back above, and then we've had recessions. I was not forecasting that for this year, but it's starting to look more and more like that. And I'll show you an even more compelling chart that suggests that a little bit later in the show. But yeah, I mean, I'm concerned about the economy at this point. The Fed's concerned about inflation. I'm much more concerned about the economy. Jobs report just came out on Friday, came in below expectations. It was up from the prior month, which was good, but it was still below expectations. It just seems like it's kind of like the stock market itself. The stock market took probably a period of 8-12 weeks to kind of go through this topping pattern and then started to roll over finally. I feel like the economy is kind of doing the same thing. We're seeing some weakness here and there, but we still see some possible strength in other areas. And then the jobs are still positive. So it's kind of like trying to hang on. But I feel like we're on the edge of something that could get much deeper. And honestly, we got a Fed meeting coming up on March 18th and 19th. And I think they need to cut rates. Europe just cut for the sixth straight meeting. And here we are leaving our rates up, and it's having a dramatic impact on the relationship between the U.S. and some of our, folks from around the globe, all the foreign indices. When you compare what's going on versus what's going on in the U.S., quite a difference. And again, I'm going to talk about some of this a little bit later in the show. So these things they're starting to unfold. So it was kind of hard to predict that it was going to happen on January 1st or in that first week. That's why I thought, okay, we got a challenging period ahead. Let's see what happens. Let's get to, that, the start of the selling and see what some of the signals are saying. I'm just telling you, they're starting to paint a little bit more bearish picture than even I talked about at the beginning of the year. Let's keep moving on. 10-year Treasury yield. So this is going to be part of what I talk about a little bit today. Notice the 10-year Treasury yield now in a downtrend. Seems to have put in a neckline, bouncing back up maybe for a little bit of a shallow right shoulder. Wouldn't be surprised to see this going back down though. And that would be opposite what you would think with inflation. But again, I think it's more about the economy than inflation. And if it is about the economy, 10-year Treasury yield is going to keep going lower. Moving on. So this is a chart. This is what I like to focus on when I'm looking at, the short term versus the long term yield on the yield curve. So you got the short end, the long end. Well, you got the 10-year Treasury yield, which is the long end. And I like to subtract the 1 month, which is the short end, to come up with the difference, that yield spread. And so the yield spread was rising. Remember, we had gone below zero. You can see over here on the right-hand side, plus 0.4 down to minus 1.6. So anything below this zero level right here was marking an inverted yield curve. And that's where we stayed for quite a while. And then we finally started to uninvert, which is good for some areas of the market. Financials love it because the spread that they can then, their net interest margin benefits from this spread turning. When the long end of the yield curve goes up and the short end goes down, that is essentially, think of the long end as the interest rate that banks use to generate interest income. The short end is the part that affects the bank's ability or their cost of borrowing. So either from deposits, when the short-term rate's going down, they pay out less for deposits, or they pay out less to borrow from other banks. And when the long end is going up, that's when they can charge more for loans and business, business loans, whatever. And so what you see is that spread start to really have a positive impact on earnings in the banks and also just in general financials. And this last quarter, financials averaged a 56% earnings gain over the same quarter last year. They were by far the best performing sector in terms of earnings in the last quarter. And we talked about this for the last year and a half, that this was coming, because when rates lower and the economy's strong, that spread widens and immediately drops to the bottom line. It's like telling Apple that, okay, you can cut a lot of your costs, and then you can also raise the price of all of your products. Well, that would be a no-brainer, slam dunk. They're going to increase the bottom line. Same thing is happening with the banks. That's what the period they just went through. That's why a stock like JP Morgan has had such a big run. It's one of the better run banks, one of the better performing banks, but it's also the fundamentals that have helped in that area. So anyway, just keep in mind that, things were kind of moving in that direction, but at the start of this year, notice what's going on. We're starting to come back down a little bit. That spread is starting to come back down. Why is the spread coming back down? Well, I just showed you the 10-year Treasury yield. Look at the last 2 months. 10-year Treasury yields dropped from 480 down to 430. So that's bringing down the ability of banks to make money. And I got to tell you, when banks start to lose, or not lose money, but when they make less money, they're less likely to lend, which I think is really what's going on in the small cap and mid cap space right now, because that's the area that really needs it. And unfortunately, policies right now are dictating that those areas are not going to benefit, at least not until the Fed makes a pivot. And I don't think they're ready to make a pivot. We'll find out in a couple of weeks. Less than a couple of weeks. It'll be a week from Tuesday and Wednesday. They have a 2-day meeting on the 18th and 19th. So we'll kind of go from there. But things, in my opinion, we're maybe poised to struggle a little bit more than what I originally thought. 10-year Treasury yield versus the 1 month. So there you have it, coming back down. Now look at the 1 month Treasury yield. Now remember, 1 month Treasury yield just kind of goes along with Fed funds rate. Fed funds rate dropped 100 basis points at the end of 2024, right? Well, 1 year or 1 month Treasury yield was at 530. Where are we at right now? 430. We've dropped 100 basis points. Fed funds stopped going down further. It's not going back up. And this is one of the vehicles, this is one of the charts that you can follow to start to get a signal for what the Fed's going to do. Because we started rolling over here on this 1 month Treasury yield chart. We started rolling over pretty significantly before the first rate cut. And you can see it just stayed for the next 90 days. We went down to that 100 basis point drop, and now we're just sitting there. Whichever way this goes in the near term or even further out, this is going to give us a pretty good clue on what the Fed's going to do. So this is a chart to watch, the 1 month Treasury yield. Now, going down a little bit further, you can see, okay, so here was the spread widening. We actually uninverted, and now we're back down to almost right at the flat line. So you got, your 10-year and your 1 month both yielding roughly the same thing, right around 4.3%, which is why we're sitting right at the zero line. But notice as we went up, look at the financials. This is the banks versus the S&P 500. Here's financials versus the S&P 500. But look at the banks now starting to roll over for the last month. Look at the financials finally starting to roll over here in March. Further is the Russell 2000. So back when we first started getting signals that we were going to, that the Fed would likely start cutting, look at the small caps. Take that huge jump, pulled back for a little bit, consolidated, and we're starting to move higher when the Fed basically pulled the rug out from under us and said, that's it. We're going to kind of start to, we're a little nervous here. We're going to kind of watch. I think at that point, right around that point is when they said we are going to cut from 4 cuts in 2025 to 2 rate cuts. And then they've later come on and just said they're pausing. But anyway, during this period, look at small caps, right back down. Look at discretionary versus staples and how strong it was going in toward the end of 2024 because we had rate cuts and we had the prospect of more rate cuts coming. That's much better if you wanted to, if you're thinking about buying, a discretionary, big discretionary item, you're much more likely to do it when you're feeling good about jobs, you're feeling better about the economy, feels like inflation's under control. Everything was peachy. Look at what's going on in 2025. And this thing is just dropping like a rock. Even last week, we finished on the low last week. So, even though it's set up for a rebound, we got a big, nice reversal in the market on Friday. That VIX is still sitting at 23. I've said before, not too many good things happen when the VIX is above 20. You got to be really careful. So, one side of me says we got a big reversal on Friday. I think we're going to jump on Monday and maybe get a little bit of a bounce. The other side of me says, be really careful with the VIX up in the 20s and with some of these other signals that we're talking about. S&P 500. So here's that straight drop down that we were talking about. It was very stubborn. Looked like, hey, maybe we weren't going to get that correction. Maybe the market is just going to keep pushing higher. Well, this kind of answered that question. S&P 500 went down almost 8% off the high to Friday's low. Didn't quite reach correction territory, which is what I think we're going to be at. NASDAQ did. Russell 2000 is already down like 17% from its high. It's almost in bear market territory. So just not looking good. And you can see we held on to a key area of support. I'm going to annotate this real quick because I believe this July top right here, you can see it. This was at 56.67. You know where we came down to on Friday? Low of 56.66, 1 point below that July level. And so looked at that and thought, hey, I was talking to John Hopkins, my partner, Friday morning. I said, if the market's going to bounce, it's going to bounce from here. And so he ended up writing a brief note to our members on Friday saying this is an area where, we could see a bounce. And we did on Friday. But if we go back and we set a new low, forget about that reversing signal. So that is a line in the sand, 56.66 near term. Be really careful if that level goes. And what would be nice, and what I would also start to grow more cautious, is if we get a bounce and get back up to the 20-day. Because we've now broken down below some key, short-term price support levels. One just below 6,000. Two, back here in December and January, close to the 5,800 level. Cleared both of those to the downside. Look at the daily PPO. I mean, it's gone below the zero line, and it is accelerating to the downside. The spread away from that zero line is just growing every single day, it seems, which is telling us that the bearish momentum is accelerating to the downside. And when that happens and you get a counter trend rally, usually it will fail at the 20-day. Look what happened right here at the beginning of March. We had gone down below. PPO went below the center line. We had one little rally attempt. It was the beginning of last week. Got right to the 20-day moving average. And what happened? Sell off. So if we get back up to that 20-day moving average, or we get close and you want to get a little bit more defensive, not a bad time to maybe take some money out of the market potentially. Let's see what else we got. Move on to the NASDAQ 100. Pretty much the same thing. I mean, nice reversal on Friday. So again, setting up for a possible bounce, but be careful on this bounce. At this point, based on everything I'm seeing, I would be more shocked. Well, shocked maybe isn't a good. I would just be more surprised if we just went right back to an all-time high now. I think that the more likely scenario is that we could bounce and then go back down to at least one more low. And then we got to see what happens on this bounce and on that next move to the downside and start, looking at those signals. to tell us what's going on in the market. I don't think we can make that call today, but we can evaluate the bounce if we get one, how it materializes, what's the rotation look like, what's our relative performance versus foreign markets, and kind of go from there. And we're going to have some fundamental data coming up. We've got inflation data this week. I think Wednesday is the CPI, Thursday is the PPI. And then, like I said, the following week, Tuesday and Wednesday's Fed meeting. So this next week to 2 week period, I think is going to be very, very telling as far as what's going to happen in the U.S. market going forward. IWM, already in this kind of A, B, C kind of pattern to the downside, accelerating, PPO very bearish, getting down closer to some key support levels. Here is one at 205. We did bounce at that one. So again, that's why I think we have a chance, an increased chance that we get a rally this week, but it's not a guarantee, not with that VIX up over 23. To the downside, 196 is possible. And then ultimately this April low down here around 190. I think all of that comes into play depending on this bounce. If this bounce is weak, I think that 190, 195 play is very possible in the IWM. Transports. Remember, we were watching this 15,750 level for so long. And transports, I mean, that's kind of like this chart is maybe like the poster child for our economy or our expected economy. And so when we start losing some, 4 or 5 month support levels, not a good sign. And we did that last week. We actually did it on Monday, followed through on Tuesday. We've tried to bounce, but we've still got the 15,750 overhead price resistance level and the declining 20-day. And check this out on Monday. We went up, tested it, we failed. PPO weakening. So it's giving us all the signs right now of a downtrend. And until the market can convince us of something else, either we need to see positive divergences start to form, or we need to see that rotation flow back toward aggressive areas. We got none of that right now. So you got to respect this downtrend. All right. So I talked a little bit. I wrote an article on Saturday, and I've actually looked at the market even more since then. So I'm wondering, and I'm beginning to think even more so, that we're probably, if we do bounce this week, this is probably going to result in a head and shoulder pattern breakdown. Now, there's no guarantee, and it doesn't trigger, it doesn't confirm until we actually get the breakdown. But I think the odds are increasing. And especially if this bounce, if we get a bounce and we get back, say, into this red, shaded area here, somewhere in the 5,800, 5,900 area, and then fail and turn right back down, that would not be a good look at all for the market. And if we break down the initial measurement, this doesn't mean that this is all that could happen. The initial measurement would be to take the S&P 500 down to about 5,225, based on my calculation, going from the high here down to the straight down perpendicular to that neckline, which would form off of Friday's low. That would be the right side. That's an assumption I'm making. Again, I don't know we're going to bounce. I think the odds are such that we could. And if we do, I'm beginning to look at it as though it's more likely than not going to be a right shoulder. May not make it to the 20, may get close. I mean, personally, I'd like to see it break through, and I'd like to see money rotate back into some of the aggressive areas. I'm just saying, based on what I'm seeing, that disparity on consumer discretionary and staples, that normally doesn't happen for a little correction or a little bit of a pullback. Normally, that kind of maneuvering, that was exactly what we saw in December 2021 before we had a cyclical bear market. So that's why I've said, at least keep your mind open to the possibility that we could have a bear market. Because I think, based on what I'm seeing over the last week, I think the odds are starting to increase. I'm not saying we're going to have one, because I've been saying the opposite. I've been saying I don't think we're going to have a bear market, that I think it'll be a correction. Maybe we get down a little bit more. Maybe it looks a little bit more like, 2015, 2016, where it doesn't reach a bear market and then turns. Some of the signals have started to suggest it could well be a bear market. So I'm going to keep my mind open. That's what I try to do. Try to remain objective. Not calling for the bear market at this point, but if we bounce this week, get the inflation reports out, then we get the Fed, I think we'll be in a better position at that point, maybe to make a little bit more of a call, give a little bit more conviction at that point. The other thing I just want to show, here's kind of how we're kind of getting these rounding tops on the S&P 500. See how it just looks like, based on the tops, we're just losing momentum. Just doesn't feel right. We had these nice highs, back down, then you go to new highs, back down, new. So we had a nice little, channel even, or trend. And then, all the struggles began January, February. I talked about the second half of February historically not being as good as the first half, or the second half of the first quarter, February 16th to March 31st, historically performing at half of what we normally see from January 1st to February 15th. That comes into play. You get through earnings season a lot of times, not just now. A lot of times you get through earnings season, it's a buy on rumor, sell on news. So you see the market sell off after earnings, which is what we're doing. So some of this is kind of normal, and some of it's a little bit abnormal. And the abnormal part is really what's worrying me a little bit more down the road. But anyway, I wanted to mention that. And you can see how complacent these are 5-day moving average readings, simple moving average readings of the equity only put call ratio. This is only a 1-year chart, but I can tell you historically, when we get this 5-day reading down to about 0.55, especially during a bull market, normally when we sit there for a while, it's an indication that, hey, maybe we've run a little bit too far. The market's getting a little too complacent. This was 100 times worse back at the end of 2021. This was not near what we saw back at the end of 2021, but it is the most bullish we've seen since 2021. And so you can see we started to sell off. The market started to get a little bit more bearish, more puts being played versus calls. That's what causes this line to go up. But look at last week. I just showed you what everything's doing last week and how, bearish the charts are starting to look. And all of a sudden, the options world starts to turn more bullish again. You give them just a little bit of a rebound and they start to get bullish again. Folks, we need to get this thing back up to 0.75. I would feel much better about getting closer to a bottom if the equity only put call ratio, this 5-day moving average, starts working its way back up toward 0.75. Because here you can see the lows in September. That was a bottom. The low in August, we got up over 0.75. That was a bottom. How about the end of April? Got up over 0.75. That was a bottom. Here, is this a bottom? I mean, not every bottom is going to hit when, with a 5-day reading at 7.75 or above, but many do. Many significant lows form when you have pessimism getting near extremes or to extremes or above extremes. And that would require this 5-day moving average to get up to 0.75. I think we've only had a couple of readings that I can remember recently where one day has been above 0.75. Now we're looking at trying to get a 5-day moving average up there. And you can see last week's selling didn't get enough bearishness going. So if we get a bounce, what I expect is maybe we get a little bit of a bounce and maybe this goes back down again. And then we get another big sell-off. And maybe that's when we'll start to see more pessimism coming in the options world. But this is something to watch for. All of these signals, everything I'm talking about really, other than the S&P 500 itself, every one of these other charts is a secondary indicator. It's not my primary, but when you start putting secondary indicator after another, one after another that are all starting to look like, hey, something's wrong with the market, that's when you start thinking, hey, something's wrong with the market. And that's where we are now. For those of you who are new to Earnings Beats, first of all, welcome. I really appreciate you tuning in. We're trying to really build our presence and our channel here at Earnings Beats on YouTube. So if you could like the video, that would be awesome. Subscribe to our channel, even more awesome. We are going to be doing some events next week. that will be live streamed. So it's always a good idea to be a subscriber. Speaking of those, actually, I'll get to those events in just a minute. If you want to sign up for our free newsletter, no credit card required. It's like our show. We're just trying to help educate folks. Name and an email address, all it takes. Hit that subscribe button. It's a chart and 2 paragraphs that come out Monday and Wednesday. So it's not really this huge newsletter. It's just something that's quick read, probably no more than 5 minutes. Monday and Wednesday. I try to get it out before the market opens. I'm not always great at doing that, but I do try. And it's just, again, an educational piece that we try to teach, try to give back to folks as they try to get through the market. Market's not easy. I think we've seen over the last 5 or 6 years, starting with the pandemic and even the trade war prior to that. And I mean, we could go back throughout history, but it's always something going on in the market. It's always very difficult to dissect everything through all the noise in the media, what's really bad and what isn't. I think we do that as well as anybody. And this will help get you started on that path to learning more about the market. So make sure you sign up. Our free education week is coming up. And if you click on it, you'll see we're going to have some courses Monday through Thursday this week, starting at 5:30 p.m. Eastern. You do have to sign up. So when you go in here, you'll see this name, email address, register for that. Members register for it. If you're on our EB Digest newsletter, free newsletter, we're not going to be sending out room instructions, only to those who sign up. And the reason we do this is a lot of folks don't want all those emails coming. It's a free newsletter. We get it. So if you're specifically interested in this educational series, we want you to specifically register for it. And whoever registers will send out the room instructions. Now, I think we're sending it out to our members anyway, but I would sign up here just to be sure. I'm not really certain as to whether we send it out to all of our members. We probably will. Anyway, just to make sure you're on the list, name and email address, hit that register now button and get set up. We'd love to have you. And by the way, if you're on your mobile device, you'll have a screen where you can up right now where you can scan that QR code, and that'll take you on your mobile device to this landing page as well. So, and you can sign up on your mobile device. Just want to make sure everybody's aware of that. All right, couple more things before we get going. So first, volatility index. You can see that is on the move to the upside. Like I said, history tells us nothing really good happens above 20 on the VIX. And if that VIX starts to really pick up, excuse me. If that VIX really starts to pick up and we get into the 30s, we're going to see a tumbling of the stock market. So what we've seen recently, I mean, we're down 8% on the S&P, but if that VIX keeps moving up, let's say we get a little bounce next week and then start to sell off again, you see that VIX get back up above the high that it just hit and above the December high. I mean, you start seeing it roll into the 30s. That's where you can see some very impulsive selling. And when I say impulsive, I mean market makers go on vacation and don't provide liquidity. So the drops become very significant and very quick. You could wake up to, futures down 3%, those types of drops. That's what happens when the VIX is, crazy high. So this is going to be an important chart to watch. Volatility index, when it gets above 20, I've said before, when it's above 20, I basically want to make sure I'm in cash. And outside of long-term retirement money that I've talked about before, where I've got some more defensive positions in for the long haul, my trading accounts are zero. They're cash. They're not zero. They're cash. Zero invested. I don't like to trade when the volatility index is up here. Even with that significant reversal on Friday, with all of these different other signals going, I'm not particularly bullish. Short term, I recognize we might get a pop, but right now I'm not looking for much more than that. All right, how about IWF versus IWD? This is a ratio I like to follow, growth versus value. And the reason I'm going to show you down here, this is the correlation going back 5 years, the correlation between the direction of the IWF-IWD ratio and the direction of the S&P 500. When they are positively correlated, they're above zero. When you get up to 1, they're going hand in hand, literally together, either to the upside or the downside, but they're going together. When they're at -1, which you can see almost never happens, they are going opposite, directly opposite. One's going up, other's going down at the same time. That's rare. And you can see we really don't even drop into negative territory that much. And it's very rare that we go past -0.50. Whereas on the positive side, if you look above 0.50, you can see it. We live up there sometimes for months. I mean, you can see right back here, beginning of 2022, hand in hand, growth was going down, the market was going down, cyclical bear market. So anyway, just want to point out there's a very, very strong positive correlation. And here's the S&P going down. And look what happened just prior to the S&P 500 going down. The IWF IWD started going down first. So that was back in the January timeframe, and that's when we turned negative, inverse correlation, because they started to go opposite one another. What happens when that happens? They quickly go back hand in hand again. But the question is, which way are they going to go? Growth was suggesting down. S&P was trying to set new highs. S&P 500 is following suit. So all of that rotation from growth to value, while the S&P 500 set its final high, told us that the S&P 500 was going to come down. Much more likely. Not a guarantee, but much more likely. All right, I'm going to end with this. This is the 10-year Treasury yield minus the German 10-year Treasury yield. Now, if you think back to when I think back to economics when I went to school, which, was back in, who knows, back a long time ago. I don't want to date myself. But I was always taught that, yields go up for a couple of reasons. One, to fight inflation. One, to, when the economy is strengthening. Normally, everybody gets out of bonds, yields go up. So, but I got a lot of other signals right now telling me that the yield or that inflation is not a problem. So I'm kind of looking at the yields telling me more about the economy than anything else. Now, the 10-year Treasury yield in the U.S. versus Germany, and when I've looked at us versus multiple countries around the world, we seem to have like the most positive correlation with Germany. Meaning that whatever happens in our market generally happens in theirs. So I like to look at the two countries to see when we're kind of getting off kilter a little bit. 10-year Treasury yield, you can see since back in 2011, we mostly have gone up and we've pulled back, kind of gone up, pulled back, gone up. And then recently it looked like we were breaking out to the upside, which meant what? It would mean that the U.S. economy is stronger than Germany's. And the fact that we've seen the yields going up in the U.S. over time more than Germany tells us that U.S. market, the economy has been better, and the stock market has been better over that same period. But look at what just happened here in the last month. While everything else is starting to roll over, look at what just happened to our yields versus Germany. Remember, I just said in Europe, they've cut rates 6 meetings in a row. We did 3, and then we stopped. And then the Fed said, oh, we're pausing. In my opinion, that was a big mistake. And I think that's what the charts are starting to say as well. Now we're starting to see other countries outperforming the S&P 500. We've been outperforming for a long time, probably the better part of 15 years, just about every other market in the world. And it's all changing right now. And a lot more solid performance is being found elsewhere, which, if you're thinking about, you got a portfolio and you maybe got X% in this, X% in this, maybe X% in international, might not be, or maybe you haven't had it in international because they've been so weak. I think what's going on right now would suggest to me that you probably want to up your international exposure. That's just my opinion. I'm not a registered investment advisor. You got to do what you want to do. And, you make your own calls and you have to live with them. I'm just telling you my perspective, showing you on the charts what's going on. But here you can see a big drop in this U.S. Treasury yield versus Germany. And there have been others where we've dropped and then come back. So it's not, it's not game over, but this is on the heels of everything else we've talked about, just another concern. And you can see that the US dollar index, which tends to follow this, I mean, if you look at this, I mean, up, down, all this, look at the dollar, pretty much up, down, up, down. I mean, the dollar kind of rides along with it. And with this drop, the dollar's coming down as well, which is telling me that our economy may be weakening relative to economies around the globe. And I'll tell you what, Fed leaves those rates up too high for too long. Remember, they didn't raise. It took them a long time to get going, to start raising, to fight inflation. Inflation kind of got out of hand. Just saying, if they let this economy weaken too long, that's going to take care of your inflation, or he's right there if you have any. I mean, if you got a weakening economy, the demand goes down. That's going to hopefully take care of inflation. And there is such thing as stagflation, where inflation remains persistent and growth weakens. That's possible. I don't think we're going there, but I've seen the word coming up recently, and based on what I'm seeing on the charts, I can't really dispute it. It's possible. But anyway, that dollar dropping right there, if it comes back down, you've got a couple of pretty good support levels over the last 3 years at about 100 on the dollar. We're at 103.78 at Friday's close. So something to watch for. But anyway, I mean, I could get into a lot more detail, but essentially these color-coded areas right in here, when it's green, we have inverse correlation, because normally, again, what I said was the spread between our yield and German yield, if it goes up, the dollar usually goes up. So when we have inverse correlation, it means they're doing something opposite. And every instance going across here, the signal that was given by the top panel, our yield versus Germany's yield, has been the one that has been correct. So in other words, if we see inverse correlation and the dollar gets off track with what's going on in the two countries' yield, the difference in their yields, the dollar falls back in line. So the dollar's the one that always corrects. Anyway, we saw that turn down, and now we see the dollar turning down with it. So got to be careful, for sure. So here are the charts. I just wanted to show you the S&P. And actually, let me go back a ways. Let's go back, just go 10 years. This was only a 1-year chart. But here's the S&P versus Germany, the DAX. See how we've been consistently going up? Look at this quick turn of events here. We've now gone back down below the 2023 low on a relative basis. We're back almost to when the pandemic started. Look at versus France. We were fine up until December. And then all of a sudden, it's like a switch. What happened in December? The Fed. I mean, if you look, there's a lot of changes that took place in our stock market starting December into January. And the biggest change fundamentally has been the Fed saying, hey, we're not going to cut rates. We're going to watch, we're going to pause, while Europe is cutting. Something to think about. The Nikkei, Japan, not quite the same. And honestly, I don't really follow all the way down here. We're still doing much better than China, but I don't really follow China. I don't think our correlations, our markets are very similar. So I find comparing the two are not really that useful. But you can see that Europe seems to be doing much better than Asia. And that is pretty evident when you look relative to how they're performing versus our index. Anyway, this was a long episode, but I tell you what, we had a lot to talk about. Things are getting serious. I thought they would be serious. I thought they would, again, back at the beginning of the year and what I've been talking about, throughout the first 4 or 5 weeks of the year when the S&P was refusing to roll over, was that I still saw a lot of weakness out there. I saw the potential of a correction. And then from there, as the market starts to fall, we have to evaluate to see whether or not I even, back in 2022, I said, hey, I feel like we could see a bear market, but we needed to see a couple of things happen first before we could kind of go there. Market doesn't go from all-time highs to a bear market overnight. It's a process. And I think what we're going through right now is the process, which is unwinding some of the strength that we were seeing on the surface when there was a lot of weakness under the surface. And so I think we're starting to see that unwind with this latest selling episode over the past 2 or 3 weeks. But what we do from here is going to help dictate how much further we have to go to the downside. Anyway, I hate talking about stuff like this because I really like for the market to go up. I like folks to do well. And a lot of folks just sit in the market, which is fine. I still think longer term, it's fine. But I'm talking about the traders, because what we do normally is trade. And you get a lot of folks that approach the market and think this market is the same as the market 6 months ago. It's not the same market for trading. What's working right now is defense. What was working back then was offense. And so you got to change your approach. If you're always trying to find these growth stocks at great bargains and you think, oh, well, they've dropped a little bit. So this is, they were just, this stock was at $100 not that long ago, and now it's at 75. What a great deal. I can tell you growth stocks can go from 100 to 20. So you want to be careful about what you consider a great deal with growth stocks when the market's heading lower. So again, if we get a bounce and that bounce is not like a really strong bounce in aggressive stocks, if you're a trader, I would probably be using that to switch, get the heck away from growth and aggressiveness. And honestly, once the bear market starts kicking, everything goes down. It's just that defensive groups tend to go down less. So you can lose less money if you're maybe trading the defensive areas. For me, my trading money, I tend to just leave right in cash. I don't like these high VIX markets personally. I would much rather trade a VIX that's at a market when the VIX is at 11 than when the VIX is over 20. You can make a lot more money. Market moves a lot more, but the moves are unpredictable. If you're on the long side and you happen to be on the wrong side when you get a impulsive move to the downside, even stops that you use, if it's an overnight gap down, it'll go right down below your stop. So if you're long overnight, that can be a big risk. And even if you have a stop in intraday and it triggers it, if it's one of these where there's no buyers, you might have a stop at say you got in at 80 and you put a stop in at 75. You might hit that stop at 75 and execute at 71 if it's one of these big days when you're dropping and the VIX is up in the 30s. So it's just a more dangerous market to trade. And personally, to me, capital preservation is just as important as making money as a trader. I mean, that's your product. If you start to lose your capital, you go from $1 million down to, you go from $1 million to 500,000, you lose 50%. In order to get back to $1 million, you got to make 100%. So it's just hard to get that money back. So again, that's why we get into volatile markets. I like to be a little bit more conservative, and I'm much more cash oriented. Anyhow, hopefully next week we have a better report, but I'm not liking the market right now, and we'll take it a day at a time. Anyway, have a great week, everybody. Happy trading.